Ladies and gentlemen, good day and welcome to the SETCO Automotive Limited Q2 FY21 quarterly results conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. I now hand the conference over to Mr. Ashish Samal from Perfect Relations. Thank you, and over to you, sir.
Thank you. Good afternoon, and thank you for joining us on SETCO Automotive's Q2 FY21 earnings conference call. Today we have with us the senior management represented by Mr. Harish Sheth, Chairman and Managing Director, Mr. J.S. Gujral, Chief Executive Officer, Mr. Anurag Jain, Assistant General Manager Finance. Before we begin, I would like to add that some of the statements to be made in today's discussion may be forward-looking in nature. We'll begin the call with the opening remark from the management, after which we'll have the forum open for interactive Q&A session. I would now request Mr. Harish Sheth to make his opening remarks. Over to you, sir.
Good afternoon, everyone. It's a pleasure to talk to you. And before we close the call, if someone goes away, I'd like to wish all of you also a very happy Diwali, as the Diwali is coming. Also, after a gloom of last year, the second half, and where we made loss for the first time. And when we discussed in September, we did not know yet direction in a proper way as to where the country will go and where the COVID will go. Not that we know anything about COVID. It's unfortunately coming in as a second round, third round in various parts of the world. But the current business indications that are coming to us from our OE customers, from the aftermarket business, it seems that coming months will be good months, and we should have better results compared to the last year or all the first quarter, even including the second quarter, the results that we have just declared. Commercial vehicle industry is also right now currently showing a growth in numbers in the third quarter, fourth quarter, as projected by them, are better than the last year's third and the fourth quarter. On an annualized basis, it will be less because the first half was a very poor month for them. As government is also we have had a very good monsoon. That's creating demand from the rural area. So the aftermarket business for various goods is also improving. So overall, we are looking at a better year, and we can talk about the results, we can talk about coming quarters, and our CEO, Mr. Gujral, will handle the question. As and when, whatever questions you have, we can open up, because I don't think we need to discuss the results, as results are already given. So why waste your time in discussing unless you have a specific question on the results or the business, if that's okay with all of you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, if you wish to ask a question, you may please press star and 1. The first question is from the line of Dipali Bansal, an investor. Please go ahead.
Good afternoon, sir. First of all, congratulations on your better results. I have a few questions. My first question would be, what will be the percentage of sale distribution among aftermarket and OEM, and how have the OEMs performed, comparatively?
So, just to give a quick recap, in our strongest year of OE is not more than 40% of our turnover.
Mm-hmm.
And we all know OE business moves up and down, and for the last 6 odd quarters it has been on a downward spiral. So obviously the OE's contribution to the overall revenue pie has been coming down. Specifically in quarter 2, it stands at 22% of our total pie.
Okay.
It is up from Q1, as Q2 was the first unlock quarter, especially for vehicle manufacturers.
Mm-hmm.
They had their own supply chain issues also, which they were untangling in most of quarter 1. And there was a migration to BS6, which we all know. So when the lockdown happened, everyone was caught unawares and were semi-prepared to kind of start production after the lockdown opened.
Mm-hmm.
So OEM contribution is improving, and in the forward quarters also we expect this trend to continue. Like our CMD said, Q3 and Q4, because of the low base, will be better for OEM compared to last year. On a full year basis, OEM volumes would be slightly lower than last year. Revenue-wise, we may be touching almost the same figures because there has been a mixed improvement because of upsizing of clutches.
Okay. So are we, as you mentioned about the supply chain issues, do we have any specific issues in our supply chain management?
Yeah, there are specific issues which are getting addressed by the day and by the hour. As you can clearly see, the first quarter's and second quarter numbers are already 4 times better. And our second quarter numbers are almost in line with our last year quarter 3, quarter 4.
Mm-hmm.
Now, primarily the issues on the supply chain side are also related to long lead items, abrupt cycles, then suddenly demand goes down, then everyone cuts, then demand comes back, everyone is tentative. So I think in quarter 3, we would be out of these issues to a 95% extent, and quarter 4, the confidence would have come in, especially when we are talking of running 3 shifts, for example, right? Or running 2 shifts for a supplier. He doesn't do it for the next 5% or 10% business. He waits for the next 50% business to come in before he increases the fixed cost. So with Q2 being equivalent to Q3 and Q4 of last year, I think that confidence now is back, and we will have this supply issues taken care of. And as far as our customers are concerned, it was mainly the imported items and the China-related issue with a lot of these BS6 components coming out of China, the electronic parts. They have found alternate sources and things like that. That has taken them a while. But all indications and the firm production plans which we have are very robust for the forward 5 months, including apart from this month. So our customers also are on a firm footing as far as supply chain is concerned.
Okay. So as you were mentioning about this, what would be capacity utilization level for this quarter?
So our capacity utilizations for the quarter are around 50%. We are not running everything 2 shifts based on the demand cycle. We will be wrapping it up, and we have sufficient headroom as far as our capacity is concerned. At a quarterly turnover of around 80 crores, we are less than 50% of our capacity.
Okay. So one last question. What exactly are we expecting from the restructuring of the power plant?
See, what has happened, we have talked this earlier also, that as the horsepower and torque has gone up, the size of the clutch has become bigger, which helps us in two ways. One is, of course, the revenue per unit goes up, and with bigger clutches, the margin percentage also is better than the existing clutches. So it's a mixed enrichment from two sides. Some of these clutches also have a higher revenue per unit because they are customized solutions for specific customers, which helps us over the life cycle of the product, because having different variants of a size will not be easy for the non-OE players to capture the market 2-3 years down the line when the vehicles of BS6 start coming for replacement cycles. So right now we are gaining on the OE front for upsizing, but over the life cycle of the vehicle we will gain not only on the revenue per unit and margin per unit, but also from a competitive viewpoint, we will be having less competition in the aftermarket.
So as you were telling me about the revenue per unit and margin per unit, would you be able to give out the figures for the same? What is the revenue per unit?
Yeah. So it's a dynamic figure. For the quarter under discussion, our mix improvement is around 12%. On a sustained basis, we expect 15%, because like I said, the higher clutches are getting into certain models. So if they pick up more traction, it will improve. That is the indication we have.
Okay.
But 12% improvement has happened in Q2, and we expect this to go to 15%.
So this is regarding revenue or the margins?
No, this is regarding revenue. So for selling the same numbers, my revenue will improve by 12%. On a margin front, it will be around 200 basis points.
Okay.
It is also reflected if you see our contribution numbers. Despite lower activity, etc., our contribution numbers compared to last year are up by around 220 basis points.
Thank you so much, sir, for answering all the questions.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. Participants, if you wish to ask a question, you may please press star and 1. The next question is from the line of Pali Bansal, an investor. Please go ahead.
Sir, I think I'm the only one in line, so I will ask all my questions. So are we expecting anything to raise any money in future, and what are our capex plans?
So we keep looking at opportunities from time to time. As we all know, the markets have not been very kind to auto sector, specifically players like us who are very focused in M&HCV segment, because we were riding the down cycle. As we come out of it, and also some RBI guidelines on investment of mutual funds in small cap companies, etc., become more friendly, we would be looking at the radar to see what are the possibilities. Having said that, we have sufficient capacity and funds to encash on the upcycle up to a turnover of around anywhere between 900 to 1,000 crores. So from that perspective, a capex cycle is not really needed on an immediate basis. We have done the investments in the past and are ready to exploit the upcycle.
Okay. So what would be the margin in the aftermarket and the OEM specifically?
So aftermarket margins in this business are always higher than OEM. We have two segments in the market. The one is which we sell through the network of our dealers, through the dealer network of our OE customers, where margins are typically around 6-7% higher than OE. And the other segment is where we sell in our own brand. The margins there are on a net basis another 7-8% higher or 700 basis point higher than what we get from OES. We exploit every opportunity, so it's important to appreciate that the business we pick up through the network of our OE customers is not 100% transferable to our own brand in IAM, and vice versa. What we sell in IAM cannot be transferred 100% to our OE customer brands. So we play this very closely to ensure that we are present in different segments, and the older vehicles beyond 6-7 years who don't look at a OE brand look at our brand, and up to 7 years when vehicles have either service contracts or go to workshops, that segment is made available to us because of our arrangement with OEMs to service their networks.
Okay, sir. Sir, in the last conference call, you mentioned that there is not much sale of new trucks being happening. Is it still the same situation, or can you see new sales of heavy commercial vehicles in the market?
So for the last 30-40 days, we are seeing definitely a change in the sentiment of our OE customers. Certain segments like tractor trailers and construction, their inquiry levels have gone up. We decipher this through the forward projections of the clutch sizes which get into various makes of their trucks. So there is definitely an improvement. These are BS6 trucks.
Okay.
So it will take, I think, another quarter or so for the customer to experience. The early adopters would buy the trucks first, and then after 2-3 months, the word spreads in the market which make, which truck, which model is the best. So we expect momentum to come in from Q3 end. But definitely footfalls and dealership inquiries, etc., from what we know, have all gone up.
Okay, sir. Sir, any update on the tractor segment?
Yeah, we are proceeding on track as far as tractor segment is concerned. We expect that in Q3 or when we are reporting Q3 numbers, we will have some definitive figures to share. But definitely we are on track to start with 2 or 3 major tractor manufacturers.
I'm sorry to interrupt. Basically, we were waiting for some companies to give us approval for the clutch to be used in the tractor segment.
Like I said, we got approval. Yeah, we've got approvals from 2 companies already in. The supplies would be starting this quarter, so we are not sharing it in this investor call. But in the next investor call, you will have definite numbers.
Okay, sir. Any
sorry to
updates?
interrupt. Ms. Bansal, may we request that you return to the question queue?
Sorry? Yes, please.
Thank you. The next question is from the line of Nitin Gandhi from KIFS Trade Capital. Please go ahead.
Yeah, thanks for taking question. Any update on US business? Can you share some more lights? Because we had put in a lot of efforts and now that things have changed. So maybe now and going 2-3 years view, if you can share.
So I think it's too early to comment on the government change there and what impact it will have on any policy shifts, if that is what was on your mind. That is, I think, some time away before we can arrive at any conclusion. Having said that, the products which we have manufactured are for the US aftermarket. We don't see the government change impacting either the overall potential or the need to have a source out of India with a OE DNA servicing that market. What definitely has happened is, because of this COVID and all that, travel, etc., has been a big restriction, and therefore some of these plans are a bit behind schedule, and we expect that from the first quarter of not fiscal year 21 but calendar year 21, these travel restrictions will get diluted. Already we are seeing in India there is a pickup in air transport and so on and so forth and all that. But we remain on track. The sales are very robust. Feedback we have from the seat population, and our strategy is to tie up with any of the major players there, and we have two strong discussions going on with two leading players there. So once the deal is inked, I think then the ramp up will be much faster.
What are the last two quarters volume, and what do you expect this size of the player with whom we are talking? What is the potential with them, which you are targeting initially? Maybe 3 years down the line, I am not saying, but some indication that with whom, what kind of size you are tying up for.
So it would be, because of confidentiality, we would not take the name of the players, but to give you an idea of the overall size, the replacement market of clutches is around 500,000 annually in US. And each clutch typically fetches us around $235 to $250. A 5% share out of 500,000 is around 25,000 clutches, multiplied by $230 to $250, you can do the maths. Now, why would a 5% share come to us? Because the US market is strongly driven by the strength of distribution and the strength of the brand. There are private labels with the truck manufacturers, their own private labels for different spare parts. Some of them want to introduce clutch sourced from us under their private label. So that's one opportunity. The second opportunity is that there are independent spare part buying houses and distribution networks who deal only with spare part. They are currently sourcing their clutch requirements out of China. With all that is happening there is renewed interest to look at a reliable source from India. And a similar thing we are also seeing from these very players on our castings front. Wherever they were sourcing from China, they are looking at having a source in India, and therefore the interest and RFQ volume, etc., is much more, many times more than what it used to be normally. And they have a definitive plan. On lava cast, for example, with one major US system supplier, we started with 30% SOB on 5 items, and right now we are discussing 100% SOB. So while it is taking time, like I said, because of these travel restrictions and all, but this is going to be a long-term business, and we are expecting the clutch pie in US to be a 70 to 100 crore business in 3 years from launch. And lava cast, of course, we are expecting 50% of the capacity to be deployed for export, which is around 15,000 metric tons annually. So these are the broad numbers which we would like to give.
This 15,000 metric ton is in rupee terms, how much does it translate? Just some rule.
Yeah, actually it will be, it depends on again the kind of components and the kind of machining and all that, but roughly it would be again ballpark around 80 to 92 crores kind of, if we just go by the numbers which have come and the rates which we have finalized. It will be ballpark in that range of 80 to 100 crores.
Okay. And this will be doing at least in mid double digit margins, right?
Yeah, the margin exports are better simply because comparison prices are the savings which they are getting from the current base. So they are more interested in having a reliable, secure, quality cautious source. They are getting their savings, but they are not haggling for the last 5 because they are more keen to balance the whole thing between price and quality and get a reliable source. So margins are better than domestic.
Okay.
So,
And what is the last quarter a Chinese supply to in US market? Any idea?
I mean,
cylinder 20 will be how much approximately?
So typically out of the 500,000, around 150,000 are with non-OE players who source either the clutch or the components of clutch out of China.
Okay. Great. Thank you very much. All the best.
Thank you. The next question is from the line of Pankaj Bobade from Axis Securities. Please go ahead.
Thanks for taking my question. So just wanted to understand what is your market share both in OE and aftermarket, and how much of the revenue, how much of these two segments contribute to our revenues?
So if we are talking of the quarter two per se, OE is around 22% and aftermarket is around 75-76%, exports is 2%. But like I said, when the OE is at the peak, this 22 can inch up to around 40.
Okay.
And this is the share of the revenue pie, which was your second question. Now coming to your first question, what is our market share? In OE, we are maintaining our market share of 85% with all the manufacturers put together. In aftermarket, combined between the two brands, our share is above 50% on an average. In the newer product, it is higher. In the older products, which have been in the market for a longer period of 10, 12, 15 years, obviously there is more competition. There it is around 35%. But in the newer products or in the newer range of trucks, like if I look, typically if we were to take an example of, let's say, a customer like Daimler who's been in the market for 4-5 years, our aftermarket share is close to 100%. I mean, there may be an odd import coming here and there, someone may be trying, but everything what is bought by them is supplied by us, and then what we sell in the market is what is the total demand for that particular site. So 50 to 55% on the whole, because a larger part of the fleet also is more than 70. But we are still getting 50 to 55% in the aftermarket.
Okay. And how is the differential between in the margins between the aftermarkets and OE?
I shared this, someone else had asked. So typically aftermarket, what we sell through our OE customers is around 6 to 7% higher. And what we sell in our own brand, net of all the expenses we have in selling that product in our own brand, we make another 700-800 basis point or 7-8% margin over and above OES.
Okay. And my last question regarding the promoter's pledge, is it not at unreasonably high level?
Well, since we have the chairman, I think
No, I do agree. It is at a very high level, and we are working towards a plan whereby our pledging will come down considerably in the coming months. This has gone high, not because we have borrowed money. What had happened was in 2018, when we borrowed money, our pledging was at around 30%. Since then, share prices have dropped, and it kept on dropping for a variety of reasons. Partly industry, partly not allowing mutual funds to invest in small cap funds. So the prices kept on dropping. So we had to keep giving more shares, and that has resulted in the high share of pledging. It's not because of the borrowing. No borrowing has been done against the shares in last 2 years.
Okay, and what are the steps we are taking to book it back?
We are working on various steps, a bit too soon, but as soon as they are crystallized, naturally market will know.
Okay, thanks a lot, sir.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. Participants, if you wish to ask a question, you may please press star and 1. The next question is from the line of Pankaj Babade from Axis Securities. Please go ahead.
So you mentioned about the potential revenue potential we have with the capacity. So can you elaborate more? What is current capacity? How much is it utilized? And as you say, we can reach around 1,000 odd crores of revenues. So wanted to have more color on the same.
So in the quarter 2, we have reported revenues of around 80 crores. That is around 40-42% of our capacity. Our typical quarter capacity on a conservative basis is 800 crores. As mix improves and we add third shift, it can be extended to 1,000 crores. Right now, we are not meant for third shift at all because the revenue, like we said, is much lower than the two-shift capacity. So that is broadly the number on capacity. 200 crores per quarter translates to 800 crores on a two-shift capacity. And then we have the third shift, which can take it up to 1,000. Plus minus 50, plus more, plus now, less minus, because of this mix improvement. Numbers may not grow as much to hit back 800 crore or 1,000 crores. The numbers may not double or become 2.5 times because the revenue per unit is improving. Definitely in OE, and then as we go forward, it will start reflecting in OES also.
But
What?
just adding to Mr. Gujal's statement, 800 crores annualized means about 200 crores per quarter. In the coming quarters, that is third, fourth quarter, we're looking at reaching well over 75% of our capacity as demand starts picking up. Second quarter initially was a very poor month.
Okay. And ideally, our margin should be around 15-16%, right?
We are talking of
EBITDA margin.
It is more on high teens, more like 17-18%, but EBITDA also gets improved a lot as activity levels go up. Currently, what we are reporting is at 40% capacity. So, like the CMD was saying, in the forward quarters, we are looking at the capacity utilization going up to 70-75%. If that happens, the EBITDA margins will inch towards high teens, closer to 20.
Okay. My last question. You mentioned that our per unit cost or revenue would increase. So what is the reason behind that? Is it change from BS4 to BS6?
Yeah, the BS6 vehicles require a bigger clutch because their engine horsepower is more. Typically, in BS4, the engine horsepower of the mass market players like Tata and Leyland was 180 horsepower. That has now inched from 180 to 230 to 280 horsepower. So obviously, you require bigger clutch. And therefore, the clutch size has improved from 380 to pretty dire. And the material content also goes up. The revenue also goes up. Some of these clutches also do customized dampening solutions for the engine gearbox combination. So that also helps the margins. So it's driven by BS6 migration here.
And the EBITDA margin increase would be tentatively by how much?
See, the mix improvement we are expecting to give us an increase of around 150 basis points on a stable quarterly turnover. See, right now we are in the ramp-up phase, so figures can go up very fast and then not go up. But as we come to normal quarters and then segments, EBITDA margins will go up. EBITDA margins will go up also because of the other reason that whatever we are reporting in quarter 2 is on a capacity utilization of 40%. And as capacity utilization goes up, even if mix does not improve, EBITDA margins will substantially improve. So mix to that extent will be big.
Sure. Thank you, sir. Thanks.
Thank you. The next question is from the line of Nitin Gandhi from KIFS Trade Capital. Please go ahead.
Yeah, can you share some experience of cutting down your fixed cost and variable cost in last 2 quarters, and what is a sustainable fixed cost per month going forward?
Yeah, if you look at our reported numbers in the year FY19, our fixed cost base was around 81 crores. We had started on a program to rationalize fixed costs in the second half of last year, which has continued in the first half of this year and will kind of end by December of this year. This would have resulted in a fixed cost reduction by approximately 16 crores on an annualized basis compared to FY19 figures. Now, going forward, we would be very, very circumspect in adding fixed costs only in the right areas. And whatever additional costs got built in over the period, we have taken prudent steps to see that we have a lower fixed cost base. A lot of our operations are now getting centralized at the plant level, so that also gives us savings of fixed costs because most of us now operate out of the plant, and Bombay office therefore has a lower fixed cost. So apart from that, we have looked at manpower very closely, and contractual manning also we are doing in a more prudent manner, if I can use that word. Rather than putting 2 more, we are putting 1 less, so that costs are in control. But on an overall basis, we've cut it down by almost 20%. And the good thing is that we made the plan in the second half of last year, so that was much before COVID and all. So we only pressed the accelerator a bit more in the first half after COVID, but the plan was ready.
So FY22, assuming whatever program you went in December, so FY22, where do you see the fixed cost stabilization? Somewhere around 60-65 crores?
Yeah, the FY21 cost will be around 65 crores. We may at best inch to 70 crores, but that would be because we would be having more contractual hiring, which was not there in Q1 and was also not at full capacity in Q2. Other fixed costs we are not increasing, right? The only variable in the fixed cost therefore is contractual hiring, which you will do when you hit higher production. Right?
Correct. Okay. Thank you very much.
Thank you. The next question is from the line of Dipali Bansal, an investor. Please go ahead.
The final question from my end. In the next 2 quarters, what do you think we can achieve bottom line?
So I think the dream figure we have is to surpass last year. Despite Q1, which was just not there, and the Q2, which was the first unlock quarter. The demand side, we are fairly confident that demand would be there and it should sustain. We have, like I explained earlier, some of the supply chain challenges getting resolved. So that is the only part where we are focused today. Ramp up as fast as possible. And we are looking at around 8 to 10% higher number than we reported last year, closer to 450 as against 420. So that is what it is. But that would mean that our third and fourth quarter are pretty robust, and the momentum which will drive us into FY22 therefore would be of a different order based on quarter 3 and quarter 4.
Okay, sir. Thank you so much.
Thank you. Ladies and gentlemen, that was our last question. I now hand the conference over to Mr. J.S. Gujral, Chief Executive Officer of SETCO Automotive, for his closing comments.
Yeah, so first of all, our thanks for sparing time to come on board and get our side of the story. The 3 strong messages which we want you guys to take home. The first is that the upcycle in the
Ladies and gentlemen, we seem to have lost the audio from the management's line. Please stay connected while we try to reconnect the management. Ladies and gentlemen, the lines of the speakers have got disconnected. Please stay connected while we try to reconnect the management. Ladies and gentlemen, thank you for patiently holding. We now have the lines of the speakers reconnected. Over to you, sir.
Sorry, we got disconnected. So the 3 strong messages we want you guys to carry home, I'm just repeating. First is that the M&HCV down cycle is firmly behind us. We are now into the upcycle, and for the next 8-12 quarters, we will definitely see improvement even on a sequential basis. The second issue is, or the point we want to highlight is that we are ramping up, and most of the issues coming out of a COVID kind of situation, which was never experienced before, are behind us now. The quarter 2 numbers reflect that. Quarter 3, quarter 4 numbers will further reflect that. And the COVID time has been well utilized to look at our costs, both on variable and fixed cost basis. We have restructured a lot of our internal workings, processes, etc. And therefore, we have a much lower break-even point as well as a much lower structure. So as the demand comes back and activity level goes up, both in SETCO and Lava Cast, we will have a far superior performance than what we have reported in the past, even at the same turnover levels. And as turnover levels improve, there will be leverage. So we have planned initiatives of growth, which we will talk more in the forward quarters on both tractors and exports, but they are also on track. So that's all from my side, and we wish you a very happy and safe festive season. Thank you.
Thank you. Ladies and gentlemen, on behalf of SETCO Automotive Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.